The stock market is a platform where buyers and sellers trade pieces of companies called stocks. Imagine a giant auction where you're bidding on ownership in businesses. When you buy a stock, you're buying a tiny slice of that company, hoping its value will rise. As companies grow and innovate, the demand for their stock increases, pushing the price up. Conversely, if a company faces challenges, its stock price may decline. The stock market is not a get-rich-quick scheme, it's a long-term game requiring patience and discipline. Educate yourself about investing fundamentals and consider seeking advice from a financial advisor. It's crucial to grasp the different types of stocks available. The two primary categories are common stock and preferred stock. Common stock represents ownership in a company and comes with voting rights and potential dividends. Preferred stock offers priority in dividend payments and asset distribution, but usually lacks voting rights. Preferred stock prices tend to be less volatile than common stock. Understanding these differences is essential for tailoring your investment strategy. Choose the type of stock that aligns with your financial objectives. Each type has its own set of characteristics and advantages. A well-defined investment strategy is your roadmap in the stock market. Two popular approaches for beginners are long-term investing and dividend investing. Long-term investing involves holding stocks for several years, benefiting from market trends. Dividend investing focuses on generating income from regular dividend payments. Growth stocks are shares of companies expected to grow at an above-average rate. Choosing the right strategy depends on your financial goals, risk tolerance, and investment timeline. Research and understand each approach before making investment decisions. Stay focused on your financial goals. Before investing, conduct thorough research on the company. Examine financial statements like the balance sheet, income statement, and cash flow statement. Look for indicators of profitability such as a healthy profit margin and consistent revenue growth. Assess the company's competitive landscape and market share. Consider the company's competitive advantages like brand recognition or proprietary technology. Research the experience and track record of the management team. A strong management team is vital for the company's success. Evaluate the company's future prospects and industry trends. Thorough research can provide insights into the company's long-term potential. The stock market is influenced by various factors, from global economic conditions to industry-specific trends. Economic indicators like GDP, inflation rates, and unemployment figures offer insights into the economy's health. A strong economy often translates into stock market growth. Interest rates set by central banks also play a significant role. Lower interest rates can boost company profits and make stocks more attractive. Industry-specific trends create opportunities and risks for investors. For example, the rise of e-commerce benefits online retailers but disrupts traditional stores. Staying informed about market trends helps identify investment opportunities. This knowledge can help manage risk more effectively. Investing in the stock market involves risk, but there are strategies to manage it. Diversification is a fundamental risk management technique. Spread your investments across different asset classes, industries, and geographies. Diversifying reduces the impact of any single investment performing poorly. Understand your own risk tolerance, influenced by factors like age and financial goals. Younger investors may take on higher risk investments, while those closer to retirement may prefer conservative options. Investing in the stock market is a marathon, not a sprint. By diversifying and understanding your risk tolerance, you can navigate market fluctuations. Stay focused on your long-term goals for success.